We're basically looking at two charts. The first one is a consensus GDP forecast rising, and the second one is the probability of US recession falling. What we're looking at is the Bloomberg consensus for US GDP. That's the one. And basically, it fell sharply in early 2025, bottoming around 1.4 to 1.5% before steadily recovering throughout the remainder of the year. And by late 2025 into early 2026, the consensus converges around 2.1% year over year. Don't forget to subscribe to this channel. We are looking for Black Swan, and we're trying to understand the stock market, and especially for my Patreon channel. I come to you every day live to tell you what's going on in the market and let you know what I'm doing with my portfolio. So the consensus converges around 2.1% year over year GDP forecast, effectively returning to a trend-like growth rate. Then, of course, the second one is the US recession falling, the probability. The Polymarket derived probability of a US recession by end of 2026 declines materially from roughly 45% chance of a recession in late 2025 to nearly 20 to 22% by January 2026. Decline is not linear, but the direction is ambiguous. Recession risk is being systematically repriced lower. Taken together, these charts depict a macro regime shift from slowdown anxiety towards soft landing confidence. Let's take a look at the GDP consensus revision. The GDP forecast path is especially revealing because how it moved, not just where it ended. In early 2025, there was a downgrade. The sharp drop in consensus expectation reflects a period dominated by restrictive financial conditions, yield curve inversion, and widespread fears of delayed monetary policy transmission. Early 2025 was really maximum pessimism. Then, in mid to late 2025, there is stabilization. The gradual stepwise upward revision suggests incoming data consistently surprised to the upside rather than one single catalytic event. Labor market resilience, consumer durability, and easing financial condition likely drove this reassessment. And then, of course, we return to 2% growth. At 2.1%, consensus implies neither overheating nor stagnation. It signals an economy expected to grow close to its estimated potential, which is precisely the definition of a soft landing. Importantly, this is not a boom forecast. Consensus is not pricing reacceleration cycle. It is pricing normalization. And this is what's amazing. We were expecting recession, right? Beginning of last year with the tariffs, with everything that was going on. It would appear that we're having a soft landing. The economy is not doing that bad. That is basically what this is telling you. Amazingly enough. Look. So let's read the recession probability signal. Okay, let's take a look at it so it's very clear to you. The Polymarket series complements the GDP data by capturing real-time risk-weighted sentiment from tail risk to background risk. A move from 45% to 20% does not mean recession risk is gone. It means recession risk is no longer the base case. Markets are shifting recession from probable to possible. Short-term spikes during the downtrend indicate sensitivity to macro headlines, policy uncertainties, and geopolitical noise. However, each spike resolves lower, reinforcing the dominant trend. When recession odds fall below 25%, investors and corporate behavior typically changes. CapEx plan, it stabilizes, credit spreads compress, equity risk premia shrink, and defensive position unwind. This matters as much for markets as the economy itself. That is what's happening. So why these two charts matters together? Historically, each chart is informative. Together, they are confirmatory. Rising GDP expectation. Answer the growth question. Falling recession odds answer the tail risk question. This combination suggests that growth is expected to be adequate, not exceptional. Downside macro shocks are being progressively discounted. The dominant risk regime is shifting from macro contraction to policy calibration and valuation risk. In other words, markets are moving from survival mode to optimization mode. Now, a balanced reading requires acknowledging limitations. Consensus forecasting is backward looking. It extrapolates recent data momentum and may underweight linear shocks, right? Predictions market reflects sentiment, not certainty. Falling odds do not eliminate the risk. They simply reflect crowd-weighted probabilities, policy errors, and over-tightening, premature easing, or fiscal missteps could reverse both series quickly. Over-tightening, well, this is what's happening right now with the Fed. The Fed is over-tightening potentially, especially in view of recession. You don't do that. These charts implicitly assume no major shock, no major surprise, no major takeover any particular country, nobody fight. No, you know what I mean? Don't read too much into it in the sense that it feels okay, but be careful. We are always prone to some sort of a surprise. And that's what we're looking for. The attachments collectively support a base case macro narratives of a late cycle soft landing. And it's characterized by trend-like growth, diminishing recession probability, reduced tail risk pricing, and greater emphasis on relative value, earnings quality, and balance sheet strength. This is a regime where macro stops dominate everything and micro valuation and positioning start to matter again.